Risk disclaimer. Leverage is a credit. Leverage is credit. So once you understand that leverage is credit and you understand that you are not the owner of whatever you have or you have gotten, then you will understand what or how to trade with leverage. Hi, my name is Emmanuel Adegbola, aka the Forex Apostle, and in this video, we are going to be looking into what is leverage, how do you trade with leverage in Forex, and why do so many traders, especially newbies, even some professional traders, lose money with Forex using leverage. That is what we're going to be looking into in this video. And if today is the first time you are visiting our channel, we say thank you to you. We don't take it for granted. And come on now, do us some favor, smash on that subscribe button, subscribe to this YouTube channel, and smash on that bell button so that you will be notified when next we upload new videos. So I'm going to be giving you just 5 seconds to do that, and we're going to continue with this teaching in a second. All right, so welcome back. So in this video, we're going to be looking into leverage. Leverage. As you know, leverage is a two-edged sword. Okay, so it can cut you and it can cut your broker and it can cut your competitors. So it's a two-edged sword. And what that simply means is that it can make you or it can mere you. It can break you and it can make you money. So why do so many people lose money with Forex trading, especially using leverage? You know, many people, when they sign up, they sign up with brokers that give them 1 to 2,000, 1 to 1,000, 1 to 5,000 leverage. Yes, if you know how to play the game very well, yes, that will make you money. But if you don't, then it's going to burn out your account so fast. So I'm going to be demonstrating this. Let's take a look into real estate. Okay, so let's assume that you want to buy a home. Okay, this home, let's say this home cost $100,000. Okay, so this home cost $100,000. So with this $100,000, if you carry your money, okay, you have $100,000 cash. If you have $100,000 cash and you pay for this, what you've just done is you've just used 1-to-1 leverage. Okay, you've just used 1-to-1 leverage. So if you buy this home outright, okay, with your money, $100,000, and you buy a home for $100,000. So let's assume that after a year, the value of this home, okay, appreciates to $200,000. Okay, so if this home appreciates to $200,000, what you have just made is $100,000 profit. So you've just made $100,000 profit. That is, you use your own money. Okay, so you just made $100,000 profit, and if the value of this home just depreciated from 100,000, okay, reduced from 100,000 to, let's say, 50,000, okay, then you just lost $50,000 of your own money. Okay, so it therefore means that the 100K you put in, you are now getting 100,000. So you lost 50,000, and if it increases to 200,000, you now have equity of $200,000. That is, you make $100,000 profit. You get that one, right? Okay, cool. So now let's look like, okay, you don't have $100,000 to put down to buy this same house. Okay, this house still cost $100,000. You don't have $100,000, but what you have is 10,000. So this $10,000 is your deposit. So you have $10,000. Then you approach a bank, and the bank say, okay, you know what? You're going to put down your 10,000, but we're going to give you this $100,000 house. That is, we are borrowing you 90,000. Okay, we're borrowing you, or let's even put it, we are borrowing you this 100,000. Okay, so we're going to take your 10,000 as your margin and just keep for you. So after a year, okay, work with me here. So after a year, or maybe the duration of the contract, 3 months, 5 years, 10 years, when you sell this house, you are still owing us $100,000. Okay, remember, you give them 10,000. Then they keep your 10,000. That is your equity right now that you use, your margin that you use in this trade. Now the banks give you this 100,000. So after 1 year, let's say the value of the house has now gone up to $200,000. $200,000 as we described in the other example. So this time around, you sell the house, then you return the $100,000 to the bank. Okay, you return the 100K to the bank. Then you have profit of $100,000. Okay, then remember, you have 10,000 equity, so you can actually collect back your 10,000. So in this case, now you have 110. So your $10,000 that you have in your account, then the $100,000 that you make as profit, so that gives you nil balance of $110,000 that you now have. Okay, that is if the value of the house goes up. So now let's now assume that the value of the house, okay, it's depreciated, and you now, instead of having, okay, this is 100,000 that the bank gives to you. After a year, the value goes down to 50K. Okay, then remember, you put down 10,000, you give to the bank. The bank keeps this for you, but the bank tells you that after 1 year, you are still owing us the 100,000. So when you now sell this house, okay, you sell this house, okay, for $50,000, you are owing the bank $100,000. So you still have to find a way to raise more money to give to the bank. Okay, to give to the bank. So in this case, now you lost minus, you actually lose, you will be losing not just your 10,000, this $10,000 is gone, then you will be losing $100,000 with it. Okay, now, so what now happened with Forex is that from the real estate, now let's take it to Forex. The bank will not allow you to lose this kind of a money. You cannot lose more than what you put in. You can't lose more than what you put in. So if you put in $10,000, even though what you buy is $100,000, as soon as your loss is getting close to this $10,000, then your broker is going to place what is called margin call on you, and that is why your trades are disconnected, and it ends in loss. And you say, wow, oh, I still have some money. But no, it is not your money, it is the bank's money. The bank will not allow you to lose their own fund. So now when you are trading, there are different leverage that you can use. 1-to-1 means that you are not using any leverage. You are just trading with your money. 1-to-50 means that, okay, to every $1 you have a buying power of 50 times what you have. Then 1-to-100 means that you have 100 times, okay, what you have. So you put in $1, you can trade with $100. And if you put in $1,000, If you put in $1,000, you can trade with $100,000. That is what this means. You trade with $100,000. So now let's assume you now have $100,000 to trade with. You have $100,000 to trade with. So now this $100,000, by the time you, let's say you are trading Euro USD. Let's use Euro USD as an example. Euro USD as an example, and you don't apply your money management or risk management very well. For this $1,000, number one, if I want to trade this, I will be trading 0.1, okay, lot size. I will be trading 0.1 lot size. That is a mini lot size. But many people will want to place, they want to trade this, then they will be trading one lot size. So when you are trading one lot size, so let's assume that it works to your favor, and you're buying Euro USD. Let's give this example. Let's say Euro USD is a let's just give a rough figure, 0.110, okay? And this moves to 1.1060. So what you have just done right there is that you've gained 50 pips. You've gained 50 pips. If you trade one lot size, this will give you $500. This will give you $500. So your new balance will now be, remember you have 1,000. So your new balance will now be $1,000 plus this $500 that you have. And of course, your new balance is now $1,500. It's good, right? Because you are making use of 1 to 100 leverage. But instead of you making these 50 pips, what if the value goes down and you lost 50 pips? So if you lost 50 pips, I mean, you lose 50 pips, it will now be, your new balance will now be $1,000 minus $500. So you will now be having your balance in your account as $500. So even though you have higher power, higher money power or purchasing power, but now this leverage you use with inadequate use of your position sizing, you have lost over, I mean, let's say 50% of your equity right there. So all you need to burn out this account is another one trade. So that is why you have to understand how to use leverage to your advantage. So now, instead of you trading one lot size, what if you decide to trade 0.1? That would be $1, a dollar per pip. Okay, so you lose this 50, you gain this 50 pips. This will give you $50. So your new balance here will be 1,050. But if you also lose the 50 pips, this will give you, instead of $500, you will now be having around $50 in your account. So you have to understand a very good money management and risk management to take advantage of the leverage that you are having. So now let's imagine that instead of these 50 pips, okay, you're still using 1 to 100, right? And the Euro USD now move from, let's say, let's just give a round figure. So it moves from, let's say, 0.0, I'm just giving an example, 200, okay? And it moves to 1.0300. So what we have made right there is a plus 100 pips. So if you trade with one lot size, okay, to Euro USD and most major currency pairs, one standard lot size is $10. So these 100 pips will give you $1,000. So, and you have $1,000 in your account. So your new balance will now be equals to 2,000. It's good, right? Wow. So you can go and celebrate and party. But now let's now assume that instead of this increase, instead of you harvesting these pips, the pips fall to 1.0100. So you just lost 100 pips. So how much is that? That is also minus $1,000. But what happens is your balance actually is 1,000. So the bank will not, or your broker will not allow you to lose this. So as soon as maybe your account is now reading, remember when you place your trade, also there's a spread. There's a spread value based on what is going on in the market around that time. So once you place your trade, you are not going to be having $1,000 again in your account. Maybe if the spread is, let's say 2, you might be having minus $20 at that particular time. So immediately you now start having minus 90 pips. Then your broker is going to place a margin call on you. Okay, a margin call, and they'll close that trade because they don't want to lose their own money. So now, what does this mean? You have to understand how to apply risk management when you are using leverage. When you're using leverage, you apply a very good money management and risk management. That is how you use leverage to your advantage. I hope you understand that example and illustration that I gave. But if you are watching this video right now and you just feel that, okay, maybe you need help, that is why we've started the Forex Apostle Mentoring Program. All you have to do is go to www.theforexapostlementoring.com. theforexapostlementoring.com. You can subscribe, monthly subscription, annual subscription, or lifetime subscription. So there should be a link below this video or at the description of this video. Read through it, and if you have any question, contact me on WhatsApp, and let's get your question answered. Okay, and if you have to meet with me at all and you have questions, I look forward to helping you. God bless you, and of course, if you have not subscribed, go ahead now, smash that button right now, subscribe to this channel, and I will see you in the next video also.